Macroeconomics for Investors. Chapter 13, Recessions. Section 1. What is a recession? A recession is a broad weakening in economic activity, not just one ugly headline or one bad week in the stock market. What matters is that several important parts of the economy start deteriorating at the same time. Output falls, income soften, hiring slows, and households and businesses spend less. That combination is what makes a recession different from a temporary wobble in one sector. A factory slowdown by itself is not enough, and neither is a rough month for investors. For practical analysis, think in terms of economy-wide weakness rather than isolated bad news. Economists usually define a recession by looking for a decline that is significant, widespread, and lasts more than a few months. In the United States, the best-known reference point is the NBER, which does not rely on any single statistic to make that judgment. Instead, it looks across measures like GDP, income, employment, industrial production, and sales. That broader approach matters because one data series can be noisy, revised later, or temporarily distorted. A true recession tends to show up across multiple indicators at once. So the key idea is not one formula, but a pattern of broad and sustained deterioration. GDP matters because it measures the total value of goods and services produced in the economy. When GDP falls, it suggests that overall economic activity is shrinking rather than expanding. You will often hear the shortcut that 2 consecutive quarters of negative GDP means recession. That rule can be useful, but it is only a shortcut, not the official definition. GDP is best treated as one important signal inside a bigger dashboard. When output weakens, the effects often spread into hiring, wages, profits, and consumer spending. It is important to separate recessions from market corrections because they describe different things. A recession is about the real economy weakening, while a correction is about asset prices falling, especially stocks. The two often overlap, but neither automatically causes the other. Markets can fall before the economy clearly weakens, and markets can recover before the economy feels healthy again. That is one reason investors get confused if they use price moves alone as a recession test. Good macro analysis keeps economic conditions and market behavior related, but distinct. Recession signals spread because the economy is deeply interconnected. If sales begin to slow, businesses usually respond by reducing production, delaying investment, or becoming more cautious about hiring. That weakens incomes for workers and suppliers, which then feeds back into lower spending. Lower spending puts more pressure on business revenue, and the cycle can continue. What begins as a slowdown in one area can become broader weakness across many areas. This chain reaction is one reason recessions often build gradually but become more visible over time. Official recession calls usually come after the downturn has already started. That is not because economists are inattentive, but because turning points are difficult to identify in real time. Early data can be mixed, incomplete, and subject to revision. GDP alone rarely gives a full enough picture, so analysts review a range of monthly indicators before deciding that the decline is broad and meaningful. By the time the evidence is convincing, the economy may already have been weakening for months. For investors, that means waiting for the official label is often too late to begin paying attention. 2 recessions can both be called recessions and still feel very different because depth and duration vary separately. Depth refers to how severe the decline is, while duration refers to how long it lasts. A downturn can be short but extremely painful, with sharp losses in output, jobs, and earnings. It can also be long but relatively mild, grinding away at confidence and growth without a dramatic collapse. Investors should care about both dimensions because they affect profits, credit quality, and market behavior in different ways. The label recession tells you a contraction exists, but not how damaging it will be. A recession usually unfolds in stages rather than arriving all at once. The economy reaches a peak. Then growth starts to weaken as spending, production, or hiring lose momentum. In some cases, GDP turns negative, but the broader story becomes clearer when multiple indicators begin deteriorating together. Only later does it become obvious that the economy has entered a true contraction. Eventually, the downturn reaches a trough, and activity begins to recover, though often unevenly at first. Thinking in stages helps you avoid expecting one dramatic moment when everyone instantly knows a recession has begun or ended. The 2007 to 2009 downturn is a useful example because GDP did not give a perfectly clear real-time signal at the start. Conditions were already weakening in late 2007, even though GDP readings were mixed. Employment, income, and industrial activity were deteriorating in ways that suggested broader trouble. Later, the recession was officially dated to December 2007. That timing shows why focusing on GDP alone can miss the bigger picture when the economy is turning. In practice, broader evidence often reveals recession conditions before a simple rule captures them cleanly. A few common mistakes can make recession analysis much less useful. One is confusing falling markets with the recession in the economy, even though prices and economic activity are not the same thing. Another is treating two negative GDP quarters as the only valid test, when recessions are usually judged from multiple indicators. It is also a mistake to focus only on GDP and ignore jobs, income, production, and sales. And finally, do not wait for the official call before you start monitoring conditions. The better habit is to follow a broader set of signals and accept that real-time judgment is always imperfect. Section 2. Recession Indicators. Once you understand what a recession is, the practical question becomes how to recognize the clues early enough to improve judgment. Recessions often leave signals before the downturn is obvious, but those signals do not arrive in a neat, certain package. Some indicators tend to warn ahead of time, while others mostly describe current conditions. A few are helpful only after the economy has already turned. That is why the goal is not perfect prediction. The goal is to assess whether recession risk is rising, stable, or fading by reading several measures together. A useful way to organize recession indicators is by timing. Leading indicators tend to move before the broader economy turns, so they can provide early warnings. Coincident indicators move roughly with current conditions, which makes them helpful for judging what is happening now. Lagging indicators usually change after the economy has already weakened or begun recovering. This timing distinction matters because investors often misuse lagging data as if it were predictive. If you know what kind of indicator you are looking at, you are less likely to draw the wrong conclusion from it. Leading indicators are watched closely because they can hint at rising recession risk before the downturn is official. Common examples include stock market indexes, building permits, sentiment surveys, the yield curve, initial jobless claims, and manufacturing surveys like ISM. None of these is reliable all by itself, and each can produce false alarms. What matters more is whether several of them weaken together in a sustained way. For example, an inverted yield curve by itself is interesting, but an inverted curve plus falling, permits, and soft manufacturing is a more serious message. Early warning signs become more convincing when they align. Coincident and lagging indicators help you separate a possible slowdown from one that may already be underway. Coincident measures such as industrial production, personal income, and employment tend to weaken around the same time the economy weakens. If those are clearly deteriorating, the recession may already be present rather than merely a risk. Lagging indicators such as the unemployment rate or some profit measures usually confirm the shift after it has happened. Unemployment in particular often rises after recession starts and can remain elevated even after growth returns. So lagging data are useful for confirmation, but weak tools for timing. Among leading indicators, the yield curve gets unusual attention because of its long historical record before many U.S. recessions. Under normal conditions, long-term treasury yields are higher than short-term yields, partly because investors usually demand more compensation to lend for longer periods. An inversion happens when short-term rates move above long-term rates. A common way to measure this is the spread between the 10-year and 2-year treasury yields. If that spread turns negative, the curve is inverted. Investors watch this because it has often signaled expectations of weaker growth and easier policy ahead. The yield curve is important, but it is not a countdown clock. Inversions have often come before recessions, yet the time between inversion and downturn has varied widely. Sometimes the lead time is relatively short, and other times it stretches much longer than investors expect. A brief dip below zero is usually less meaningful than a sustained inversion that persists over time. That is why the curve should be treated as a warning signal, not a precise timer. It tells you risk may be rising, but not exactly when the economy will contract. No single recession signal is enough because economic data are noisy, incomplete, and often revised later. One weak reading may reflect a temporary shock, a seasonal quirk, or plain measurement error. Even strong indicators sometimes send false signals. Combining several indicators reduces the chance that you overreact to one misleading data point. For example, rising jobless claims become more meaningful if manufacturing is also weakening and confidence is falling. Good recession analysis looks for confirmation across different parts of the economy. The broader and more persistent the weakness, the more convincing the signal. A practical monitoring process can be simple without being simplistic. You might follow the 10-year minus 2-year Treasury spread, initial jobless claims, ISM manufacturing, and consumer sentiment. The point is not to react to each release in isolation, but to watch for sustained alignment over time. A one-day inversion, one noisy claims report, or one weak survey reading may mean very little. But if the curve stays inverted for months, claims trend higher, ISM stays below 50, and sentiment deteriorates, the message becomes more serious. A short list followed consistently is often more useful than an enormous dashboard followed inconsistently. The strongest recession warnings usually appear when the data line up across categories and the weakness lasts. Start by asking whether at least two leading indicators are pointing in the same direction. Then check whether coincident data are beginning to support that message. Just as important, distinguish a one-off move from a pattern that repeats across several reports. Major decisions should not rest on one headline number. What you want is alignment, persistence, and cross-confirmation rather than a dramatic but isolated signal. Imagine an investor sees a yield curve inversion lasting for months, ISM manufacturing below 50, and initial jobless claims beginning to trend higher. None of those signals proves a recession on its own, but together they suggest weaker growth expectations, contraction in manufacturing, and softening labor demand. In other words, the balance of evidence has shifted. That does not mean panic or trying to predict the exact start date of a recession. It means the investor may want to review cyclical exposure, reassess cash needs, and use more conservative assumptions. Several mistakes show up again and again when people use recession indicators. One is treating stock declines as automatic proof that a recession is coming, even though markets can fall for many reasons. Another is assuming an inverted yield curve means a recession is immediate, when lead times vary a lot. Investors also misuse lagging data by trying to forecast, with measures that mainly confirm what already happened. And many people overreact to one noisy report while ignoring revisions and the broader pattern. The better approach is to focus on the balance of evidence, not exact timing. Section 3. Consumer behavior. Recessions are deeply tied to consumer behavior because household spending is such a large share of total demand. When families become cautious, the effects reach far beyond their own budgets. Lower spending means lower revenue for retailers, restaurants, manufacturers, and service providers. Businesses then respond by reducing hours, slowing hiring, or cutting investment. That response can weaken incomes and confidence further. So many individual household decisions taken together become a powerful macroeconomic force. A recession can feed on itself because what is prudent for one household can become harmful when many households do it at once. If families worry about job security or income, they often cut spending to protect themselves. Businesses experience weaker sales and respond by cutting hours, hiring, or jobs. Those actions reduce income for more workers, who then spend less as well. The result is a self-reinforcing loop between household caution and business weakness. This feedback process is one reason downturns can deepen even without a new shock arriving every month. This self-reinforcing pattern is closely related to the paradox of thrift. Saving more is often the sensible choice for an individual household, especially when the future feels uncertain. But if many households raise savings and cut spending at the same time, total demand in the economy falls. Lower demand hurts business revenue, which can lead to layoffs, reduced investment, and weaker income growth. So thrift itself is not the problem. The problem is synchronized caution across millions of households during a downturn. To understand consumer behavior in recessions, it helps to separate spending into essential and discretionary categories. Essential spending includes things like housing, food, utilities, healthcare, and basic transportation. Discretionary spending includes dining out, travel, entertainment, electronics, and many non-essential purchases. In hard times, households usually try to protect essentials first and cut discretionary items sooner. Even so, the line is not always clear. What counts as essential for one family may feel discretionary for another, depending on income, savings, debt, and life circumstances. In most recessions, households cut discretionary spending first and fastest. They may delay buying a car, postpone home improvements, cancel subscriptions, or eat out less often. Those categories are easier to pause because the household can function without them for a while. Essential spending usually holds up better, but it still changes. People may switch to cheaper brands, reduce energy use, move to lower-cost housing, or even delay medical care. So recession behavior is not just about spending less. It is also about trading down, delaying, and reprioritizing. Income losses can hit spending especially hard because households differ in their marginal propensity to consume, or MPC. MPC refers to how much of an extra dollar of income a household is likely to spend rather than save. A high MPC household spends most of that extra income, so losing income usually causes spending to fall quickly. A low MPC household saves more of each extra dollar, so its spending may be less sensitive to a comparable loss. Lower income households often have higher MPCs because they have less financial cushion. That means income losses concentrated among them can reduce overall spending more sharply than many investors expect. Consumer behavior is shaped not only by income, but also by confidence. People often become cautious before their finances have clearly worsened, simply because they fear they might worsen soon. When confidence is high, households are more willing to make big purchases, borrow, and commit to long-term expenses. When confidence falls, they tend to save more, repay debt, and postpone major decisions. News about layoffs, market declines, or economic uncertainty can trigger this shift even before paychecks change. That is why psychology can lengthen the downturn. Fear alone can reduce spending. A downturn often spreads through a recognizable sequence. First, a shock hits income, wealth, or confidence. Households then cut discretionary spending because those purchases are easiest to delay. Businesses lose revenue and respond by cutting costs, hours, inventory, or hiring plans. More workers are then affected, which feeds back into lower spending across the economy. The slowdown spreads through that loop until something interrupts it, such as stabilizing jobs, improving confidence, or policy support. A local example makes this process concrete. Suppose a factory closure removes $40 million of annual income from one town. Affected families immediately cut back on restaurants, car purchases, entertainment, and other discretionary spending. Local businesses then lose revenue and may reduce staff or cut employee hours. Those secondary job losses spread the pain beyond manufacturing into retail, services, and small business activity. In that way, one original shock can ripple through an entire local economy. There are several common mistakes when analyzing consumers in recessions. One is assuming essential spending never falls, when in reality people often trade down, delay, or trim even necessary categories. Another is treating all households as if they respond the same way, despite major differences in savings, debt burdens, income stability, and job risk. It is also easy to ignore the feedback loop between households and businesses, even though that loop is central to recession dynamics. And many analysts underestimate delays, habits, and psychology. Consumer behavior is not mechanical. It is shaped by constraints, expectations, and fear. Section 4. Market crashes. A market crash is more than a market that happens to be down. What defines a crash is the combination of speed, scale, and panic. Prices fall sharply across a major index, often over just days rather than months. Selling becomes sudden and fear-driven, and confidence breaks down quickly. That is what separates a crash from an ordinary pullback or gradual decline. In a crash, investors are not calmly repricing risk. Many are simply trying to get out. It helps to keep three terms separate: correction, bear market, and crash. A correction usually means a decline of roughly 5 to 10%, often unfolding over weeks. A bear market is deeper, typically 20% or more from a peak, and often lasts longer. A crash is defined mainly by speed and panic rather than by one fixed percentage. A crash can happen inside a bear market, or it can begin one. These are related ideas, but they are not interchangeable, and using them loosely can blur what is actually happening. Crashes often hit harder during recessions because the market is colliding with an already weakening economy. Earnings may already be falling, unemployment may be rising, and lenders may be tightening credit. That means bad market news is arriving on top of real economic stress. Investors are not only worried about price declines, they are also reacting to weaker profits, more defaults, and slower growth. In that environment, fear spreads faster because the negative story feels more credible. A fragile economy gives a crash more force. During recession-era crashes, panic can turn into a self-reinforcing spiral. Investors rush to sell, prices fall sharply, and those lower prices create new reasons to sell. Stop-loss orders trigger, leveraged positions get pressured, and fear starts to outweigh fundamental analysis. Margin calls and forced liquidations add even more selling pressure. Liquidity can also dry up, making each trade move the market more than usual. The result is that falling prices become both the symptom and the accelerator of the panic. A crash is not just about lower prices, it is also about deteriorating market liquidity. When prices fall quickly, leveraged investors may face margin calls and need cash immediately. To raise that cash, they sell assets fast, often without much concern for long-term value. If many investors try to do this at once, sellers overwhelm buyers. Bid-ask spreads widen, trading becomes more costly, and even strong companies can fall simply because the market is short of liquidity. In that kind of environment, quality does not fully protect price in the short run. Crashes often follow a recognizable sequence, even if the exact path differs each time. A negative shock hits expectations, such as a policy surprise, credit fear, or sudden earnings concern. Indexes drop quickly and trading volume surges as investors react. Forced and systematic selling can then accelerate the move, especially through margin calls, stop losses, and rules-based strategies. Trading hots may temporarily pause the decline, but they do not automatically restore confidence. Stability usually returns only when selling pressure fades and buyers are willing to step back in. A crash does not always cause a recession, but it can make an existing downturn worse. Falling portfolios make households feel poorer, which can reduce spending. Businesses may also face tighter financing conditions, making investment and hiring less attractive. Confidence weakens across both consumers and firms, and that can further depress demand. Lower spending then pressures profits and can lead to layoffs. So even when the crash is not the original cause, it can deepen and prolong recession dynamics. The early 2020 crash is a vivid example of how quickly market behavior can change under stress. The decline was extremely fast rather than gradual, and volatility surged as uncertainty exploded. Stress spread beyond individual stocks into credit and other parts of the financial system. Investors prioritize cash, liquidity, and risk reduction over careful company-by-company analysis. In moments like that, even strong businesses can fall along with weak ones. The episode shows how panic and liquidity stress can temporarily dominate fundamentals. Several mistakes are common when people think about crashes. One is confusing a crash with a bear market. Even though crashes are defined mainly by speed and panic, while bear markets are broader and often longer. Another is assuming every crash starts a recession, when sometimes the economy stabilizes before that happens. Investors also forget that strong companies can drop sharply during liquidity stress. Leverage and execution risk matter as much as valuation in those moments. And perhaps most important, market bottoms are usually obvious only in hindsight, not in real time. A useful way to study crash mechanics is to look closely at the week of March 9, 2020. Calculate how much the S&P 500 changed from March 6 to March 12, and notice how quickly the move happened. Then pick one company in the index that reported earnings around that time. Ask whether the stock reaction really reflected only that company's results, or whether broader crash conditions dominated the response. In a panic, investors often focus on cash, liquidity, and de-risking rather than careful valuation. That exercise helps connect market mechanics with actual investor behavior under stress. Section 5. Recovery Patterns. After understanding downturns and crashes, the next question is what recovery actually looks like. A recovery begins when the economy moves from contraction back toward expansion, but that path can take very different forms. Investors often use letter shapes like V, U, W, and L as shorthand for the depth of the decline and the speed of the rebound. Those labels are helpful, but they are only rough guides. The more important issue is what is driving the recovery underneath the shape. A label can describe the pattern, but it does not explain why that pattern is happening. The four common recovery shapes differ mainly in speed and durability. A V-shaped recovery means a sharp drop followed by a quick rebound. A U-shaped recovery means the economy falls, stays weak for a while, and then climbs gradually. A W-shaped recovery means the rebound starts, but the economy slips back again before recovering more firmly. An L-shaped path is the harshest case, a steep drop followed by prolonged weakness. These shapes are useful because they summarize the rhythm of recovery, not just the fact that recovery eventually arrives. What makes one recovery shape more likely depends on what the recession damaged and how quickly the economy can repair it. Temporary shocks often allow faster rebounds because the underlying system remains mostly intact. Heavy debt can slow recovery by discouraging spending and investment. While balance sheets are repaired, weak banks can restrict credit and hold back growth even after the initial decline ends. Confidence and policy support also matter because households and businesses need reasons to spend, hire, and invest again. Global conditions can either help the rebound through trade and demand or weaken it further. Recovery is best thought of as a sequence rather than one dramatic turning point. The trough is the low point, but it is hard to recognize in real time. An early rebound may begin before the recovery is truly durable, especially if it is driven by temporary relief or policy support. After that comes a repair phase, when jobs, credit, and demand slowly heal. The strongest recoveries arrive when private demand can sustain growth without extraordinary help. For investors, this matters because the first bounce is not always the same as full economic healing. Policy and confidence can strongly influence whether a rebound gains traction or fades. Lower interest rates and liquidity support can help keep credit flowing when the private sector is stressed. Government spending and transfers can stabilize demand and limit the depth of the downturn. But policy support works best when households and firms are willing to respond by spending, hiring, and investing. If confidence remains weak, the rebound can stay fragile. And if support is withdrawn too early, the economy can lose momentum or even slip into a double dip. For investors, one of the most important facts is that markets often recover before the real economy does. Stock prices are forward-looking, so they tend to bottom when expectations stop worsening, not when current data look healthy. That means a rally can begin while GDP, employment, and profits still appear weak. The market is reacting to the future path, not just the present pain. This timing gap can feel uncomfortable because the headlines still look bad, but waiting for full economic confirmation often means missing a large part of the market rebound. Recent history offers a useful comparison between two very different recoveries. The 2007 to 2009 financial crisis is often described as more U-shaped because growth returned slowly and labor markets took a long time to heal. The damage involved housing, credit, and private sector balance sheets, which are not repaired quickly. The 2020 recession, by contrast, looked more V-shaped in many economies. The shock was sharp, but it was also more temporary in nature, and strong policy support helped speed the rebound. The cause of the recession often tells you a great deal about the path of recovery. A U-shaped recovery is characterized less by the initial drop than by what happens after the drop. GDP stops falling, but instead of rebounding quickly, it stays weak for several quarters. That lingering period near the trough is the defining feature. Slow improvement often points to weak confidence, tight credit, high unemployment, or policy support that is too limited or too slow. In this kind of recovery, the economy is no longer collapsing, but it is not regaining momentum quickly either. Investors should hear U-shaped and think prolonged healing, not immediate rebound. Recovery labels are useful, but they are easy to misread if taken too literally. One common mistake is treating the first bounce as proof that the economy is fully healed. Another is confusing a market rally with a broad economic recovery, even though markets often move earlier. It is also a mistake to treat V, U, W, and L as exact templates rather than rough descriptions. And analysts sometimes ignore the risk that policy support is withdrawn too soon, which can interrupt a fragile rebound. The shape is only the starting point for analysis, not the final answer. For investors, the key question is not just which letter fits, but why the recovery is taking that form. Start with the cause of the downturn. Was it a temporary shock, a financial crisis, a policy mistake, or something more structural? Then ask how much damage was done to banks, balance sheets, labor markets, and confidence. Watch whether credit conditions are improving and whether households and businesses are willing to spend on their own. The most durable recoveries are the ones that can continue without extraordinary support. Looking beneath the label leads to better judgment than memorizing shapes alone.